get about 4 billion. The securities trading bit was just the area where was challenged. But overall, you also look at the expenses. They were able to manage the expenses, declined by 18%, which is commendable in this era where the economy is challenged and costs of running the business is skyrocketing. So overall, coming out with a profit of about 6 billion, 6.9 billion if you had the sales from the gain of that asset. It's something commendable, and that was what informed the 50 kobo dividend, which is higher than the 35 kobo dividend that was paid last year. And when you also look at some of its margins, very impressive. PBT margin, PAT margin up 70%, 60% respectively. So overall, we feel investors have priced this in. If you look at the performance of the shares, in the last 1 year, it's gained over 252%. In the since the divestment, it's gained close to 79%, and year to date, it's gained like 35%. And that's what is responsible for the short. You discover that it didn't gain maximum on Friday. It gained just 3.5%. Investors are already taking profit on the stock.
Oh, okay, so it's actually sustaining its momentum. But basically, why are we saying delay in the release of earnings? That's about the only one that was released this week.
Yes, we all know in terms of expectation, most of the companies would be publishing very disappointing results, ranging from the financial service to consumer goods to the industrial goods. Maybe from experience, one of the things that may be responsible for that is when you're trying to agree in terms of the audit with the auditors. They want to make some provisions, they want to back out some things. The back and forth sometimes takes time. Also, the company will also be trying to gauge sentiment. No matter how impressive your results may be, if the overall market sentiment is still very negative, it may douse that impact that you have on your share price. So timing is also very key, though they have a deadline of 90 days, so which they still have enough leeway to still gauge the market.
Some of your contenders or counterparts basically in the market have also issued issued a report on the cement sector, and they're like, it's not going to be so good this time except for the likes of Dangote Cement. What do you make of that? Is that in terms of earnings? That's what I'm saying.
Yeah, it's not far-fetched. We all know the challenge most companies are experiencing in terms of FX. But maybe why Dangote may be shielded slightly from that is because of other businesses that gives it access to FX. It also exports, also have businesses in other African countries. So it would help reduce that effect that the FX devaluation or depreciation should have on its results.
Okay, but during the week as well, Fitch Ratings revised the outlook on 4 Nigerian banks, and that's to negative from stable, and it also affirms the long-term usual default ratings of 10 other banks. Now the IDR outlooks on Zenith and GT Bank, Diamond Bank, and First Bank have now been downgraded. Talk to us about how this will change the sentiment on that market, on these stocks.
Yes, maybe most investors may be surprised to see GT Bank being downgraded, but if you do a critical analysis of GT Bank's results, you discover that it's the revaluation of FX that have been boosting its earnings, both top line and bottom line. Well, what this holds for these stocks is that for fund managers that invest based on ratings, they may have to reduce the exposure to some of these stocks, which would also impact on its price. Notwithstanding, we expect GT expect to sustain its positive results. GT Bank did H1 audited results, so the fluctuation will not be as significant as some of the banks that have not done since last year. They have not done their audit since last year. So overall, for some of GT Zenith, we still expect that the result will be positive. But in terms of its impact on share price, we may see we may see sell down on some of the stocks based on the investors' policy statement of some of these investment policy statement rather of some of these companies or fund managers.
Okay, so let's switch gears to the Treasury single account, where the federal government has said it is going to be expanding its coverage on the TSA, and we know that a lot of funds for the public sector and the private sector both coming through the bank. Though we have the CRR ratio, but how is this going to change? What is this going to really change in the banking stocks? Because some have projected or argued that, look, this is really going to impact on the banks as well. I know you do at AfriInvest do a lot of reports on the banking sector.
Yes. Based on what has happened in the past, most of the banks have reduced their exposure to public sector funds. So we don't expect that the shock will be as much as what was experienced in the last time the full implementation was announced. Okay. And over several billions or trillions were raked in from the banking space. What we just expect to see it may increase the cost of lending because maybe cost of public sector deposit most times may come cheap. Okay. And when you look at the weighted average of your cost of funds may now increase if you don't have access to that to that kind of funds again. But when you flip it the other way around, for the government, it helps them to see an holistic view of their liquidity, and they become more efficient and be able to reduce the costs of managing their cash flow.
Okay, inflation for January came in at 18.72%. Did that change anything in the market?
No, not really. Because just like you mentioned earlier, 7 bips above January, which is in line with our expectation. Investors already priced that into fixed income yields, and you'll discover a lot of investors are going long, and we will see that would persist in the interim.
But will it be out of place to say that the high inflation that we've been seeing sustained all this while has bottomed down? Because I think it started, it hit the rise momentum February last year, and this is February 2017. One would literally expect that, look, we've seen a 12-month period, there should be a turn in the curve.
Yes, we expect to see a turn based on the high base effect. Okay. If you also look at it based on a month-on-month basis, you see that it has continued to moderate on a month-on-month basis. So we expect that it should moderate in March based on that high base effect.
All right, thank you very much. Ayode Jebo, Acting Managing Director at AfriInvest Securities. By the way, I should say congratulations to you on your new appointment.
Thank you. Thanks for having me.
Thank you so much. Viewers, next week we take a look at some of these events that will be coming up. Capital Market Solicitors meeting, like we said earlier, is scheduled for Tuesday, 21st of this month. Forte Oil bond listing on the Nigerian Stock Exchange, and of course on the FMDQ OTC Securities Exchange on the same day, Tuesday. That of FMDQ is for 10 a.m. That of the Nigerian Stock Exchange is for 2 p.m., where the management of that company will sound the closing gong, as well as the Green Bonds Capital Market Conference scheduled for Thursday in collaboration with the Nigerian Stock Exchange. That is all the time we have on Capital Market this evening. I'm Temple Ashaju. Let's continue the discussion on Twitter at Channels TV at Temple. And I'll see you next time.